Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Mohamed El-Erian of Queen's College, Cambridge, staying focused on the bond market and writing, some label 2024 as ushering in the return of bond vigilantes. This greater focus on debt and political stability is likely to continue into 25, as will the extent of dispersion between the United States, the Eurozone and Japan. I'm pleased to welcome a good friend of all of ours, Mohamed El-Erian. Mohamed, good morning.
Good morning, John.
And a happy new year to you. It's the final day we can say. It's January 10th.
So we'll say it all day.
The rules of Bloomberg surveillance. Mohamed, are the bond vigilantes back? And if so, what's changed? Why are they back?
They're back because of three issues, as you know, John. One is consistently stronger than expected U.S. economic data. Two is the understanding that inflation will be sticky. And three is there's renewed focus now on debt and deficits. Put these three things together, the U.S. leads a global bond sell-off, and then what that sell-off does, it picks vulnerabilities in the system and weaknesses. And it wouldn't have been good afternoon Britain, it would have just been afternoon Britain, because they are facing the combination, the emerging market combination of higher yields and lower currency, which is really bad news for them right now.
How much of that is in their own control?
Some of it is in their control, and it is a golden opportunity for this government to redouble or restart its economic approach, which has lost its way a little bit in the last few months. But they will be looking at the U.S. jobs report and critically the CPI coming up. You know, it's not so long ago, Lisa, that we used to say, okay, forget about CPI, inflation's under control, all that matters is the jobs report. Now suddenly we've realized that both are in play, inflation and the employment part.
So when we say afternoon in Great Britain, because no one's saying it's particularly good right now, what is better for them? An upside surprise to labor markets or a downside surprise at a time when potentially that could spur some sort of risk-off move at a time when, even in the United States, people are really questioning the sustainability of what's going on?
Yeah, and that's the issue. If you're in the U.S., you really want an upside surprise. If you had the choice between the two, you take an upside surprise. If you're in Britain, you take a downside surprise. Yields have got to stabilize. Otherwise, you risk triggering these dynamics that can really hurt. So they would hope for a downside surprise that brings yields down here and puts downward pressure on their yields.
When you talk about bond vigilantes and how they find the most vulnerable spots, how long is it before they find the United States particularly vulnerable? And this sort of goes to the heart of the question that Torsten Slok raised, which is it is highly unusual to see the long end yield rise by 100 basis points after a series of 100 basis points of rate cuts from the Federal Reserve. Do you have a sense that maybe the U.S. is one of those vulnerable spots at this point?
In relative terms, no. You know, you've heard me say over and over again, the good, the bad, and the ugly. The good is the U.S., the bad is China, and the U.K. is Europe, including the U.K. The ugly is Europe, including the U.K. So U.S., China, Europe, including the U.K. They'll focus on the ugly first, and then they'll creep up. The U.S. has a particularly good spot because higher yields here are associated with stronger growth. That is not the case in Europe.
So why do you think the Federal Reserve is so confused? At least they sound confused, based on the news conference back in December.
How much time do we have?
We've got enough time to go through it.
2 hours.
Okay, so they've been confused in their analysis. They've been confused in their communication. They've been confused in their approach. When you're data dependent and you're just looking at the future through the lens of the past, you will get more and more confused as we go through these changes. And we haven't even talked about policy uncertainty, which adds to this. The reality is right now we could solve at different levels of employment and inflation. Whatever scenario you had for recession, soft landing, no landing, whatever probabilities you had, now each of them is associated with different levels of inflation. And that is new. So the Fed, and you've heard me say this for a long time, has got to get more strategic in its approach and has got to stop being excessively data dependent.
They say this phrase that you use, policy uncertainty, and when I hear it, I just think Donald Trump. Well, they actually mean to say it's Donald Trump, and you saw that in the minutes, and I think we heard that in the news conference with Chairman Powell. I'm struggling to understand this, and I'd love your opinion on this. Why some officials on the Federal Reserve are willing to preempt policy changes and factor that into their observations and their forecasts, but unwilling to do so when it was Biden in the White House and he was pushing through massive fiscal stimulus into a supply-constrained economy, and they sat there and let inflation rip. What explains the difference between the behavior and the response and the approach to two different presidents?
You know, you've got to ask them. We thought we understood how the Fed approached this when Chair Powell said, quote, something along the lines that we don't speculate, we don't predict, and we don't assume anything about policies. So everybody assumed, you know what, let's wait and see. And what we're hearing from the Fed does not incorporate forecasts about policy changes. And then the whole thing got muddled. And now some do, some don't, you're not quite sure what. And I think this is part of a bigger issue, which is Fed communication has gotten really confused. Bill Dudley had a really good piece in Bloomberg Opinion about this. And it does matter because the Fed is supposed to reduce volatility, not contribute to volatility. And for the last few years, the Fed has contributed to volatility.
How do they not contribute to volatility when they are facing off with policies that offer up profoundly different contours of inflation and growth?
So, first of all, they've got to either take the approach of this is what we think the baseline is. We are going to check it every single day against more signs out of DC. Or alternatively, we're not incorporating any new policies. Sometimes you need a top-down, you need the chair to say this is the approach we're going to take for now. Because the muddled middle causes all sorts of spillover effects that are not helpful at all to them.
So let's talk about the spillover effects. We've talked before about how they're at risk of maybe allowing inflation to creep higher and then have to hike rates later. The idea of not recognizing inflation enough. There's the other side of things. If they hold rates too high for too long, they could cause a deterioration, a dramatic deterioration in the economy. Right now, which is the bigger risk?
So the only reason we talk about the inflation risk is because we compare it to an arbitrary target that I'm willing to bet if we were to set today, we would not set at 2%. We'd set at 2.5 to 3. Every other indication of inflation suggests that inflation expectations are stable. It just, what's structurally happening here and in the rest of the world means that you're going to run the economy for now at a higher equilibrium inflation rate than before. And it's not, so the reason why we're getting in this whole thing is because we are judging ourselves against a target that itself is not only arbitrary, but would not have been the target we would have chosen today. I don't worry, honestly, about inflation until I have evidence that inflation expectations are de-anchored. And there's no evidence of that at all. I do worry that if the Fed truly believes that it has to achieve 2% and wants to do it, it's going to have to hike rates this year. And if it hikes rates this year, it's going to pull the rug from under U.S. growth. It's going to pull the rug from under U.S. investment. This is how important it is. So my expectation is they'll fudge. They'll say we continue to pursue 2%, but down the road, they'll stick with a 2.5% target forecast for now, saying on the way to 2%. But we'll basically be living with a high inflation target.
Mohamed, we're lucky to have you. Anne-Marie joins us now from Washington with Ed Mills of Raymond James. Anne-Marie, over to you.
Good morning, Jonathan. The clock is literally ticking for TikTok, and today they're going to have their day at the Supreme Court to try to combat this bill. And they will either be banned unless they divest away from ByteDance, this Chinese company. What do you think happens, Ed?
I think on January 19th, TikTok ceases to exist here in the United States. I think the wild card here is that under the law, the President of the United States has an ability to extend one time for 90 days. So the question that I have is, come January 20th, the next day, does Trump activate that 90-day extension, and is there a deal worked out?
It sounds like he's going to, because he's flip-flopped since his first time in office, in the Oval Office, when he talked about the security concerns of TikTok, that now he thinks, actually, in an interview with my colleagues over the summer, talked about the fact that, well, if you don't have TikTok, then Meta's too big, and he understands a lot of individuals get their news from there. It seems like he wants to keep it around. So what are the options, even if there's an extension?
So after the 90 days, one of the things we went through the statute at Raymond James yesterday, published a report about this, and ultimately, it is up to the president to declare that what has happened with the divestment or for foreign ownership has met the needs of the law. And so as long as the president declares, it's okay. The problem for Trump, though, is that if there is not a divestment, a $5,000 per user fee gets kicked in. And I don't think the app stores at Apple or Google or Oracle's hosting of this wants to exist, because when you look at the number of users, I add that up to about an $85 billion fine. And unless you change the law or you have this divested, it will cease to exist, assuming it is upheld by the Supreme Court.
Who can buy this? This isn't even like Elon Musk buying Twitter. This is an incredibly expensive company.
Yeah, I assume the money would be there. The bigger question for me is, will the Chinese government allow it to be sold? Because ultimately,
well,
if
they
you
said no.
Yeah, because you could open up the hood, you look in, and everything that the national security folks have said about keystroke capture, about geolocation, about the algorithm potentially manipulating the users of TikTok, all of that will be very apparent. And we will know even more of how the Chinese have been spying on Americans using a very popular app.
Trump will also be breaking with his national security advisor and his secretary of state.
And? I mean, it's just like Trump will break with his administration whenever he wants. I do think it's important that you highlight the kind of animus that he's had towards Meta and towards the potential benefit to Instagram because of this. It does look like some of that animus might be reduced over the actions by Meta, by Mark Zuckerberg in recent weeks, trying to get him okay.
Do the concerns grow on a day like today when CNN comes out and says that Chinese hackers breached CFIUS in December? Not really a surprise, as Jonathan said, because we do know that there was Chinese hackers breaching the Treasury Department. But doesn't this become even more of a national security concern? And what's going to be the response from Trump 2.0 to Beijing? Yeah, I mean, I think it is a extraordinary act that, we knew that there were Chinese hackers that accessed Treasury. It was downplayed by Janet Yellen recently, but for them to have hacked into CFIUS, the Committee on Foreign Investment into the United States, there was a deal that was pending, Nippon Steel trying to buy U.S. Steel. We were looking at all of the potential national security concerns about that, Nippon's operations within China. For them to be looking for exactly what was happening at CFIUS at that time is a huge concern. And that's why I've always said almost everything in D.C. related to China is bipartisan. The only place you don't want to be is being seen on being on China's side. Well, except for potentially one. We are waiting for a Commerce Department to come out, and this was a Bloomberg scoop, but I know you've been writing about it for months, about AI chips from NVIDIA. And all roads really lead to China when it comes to wanting to make those export controls tougher, correct? Yeah, so as early as today, and it's going to happen between now and January 20th, there's going to be a final export control rule that comes out from the Biden administration. This is going to be focused on the number of AI chips that are going to countries that we have concerns about. Now, we've blocked almost everything going to China or to Russia. We're going to allow everything to continue to go to our closest allies, but there's going to be a tier 2 company or country list where we're going to put caps on how much can the Middle East get, how much can Southeast Asia receive. Now, generally speaking, I would have expected this to be bipartisan, but you have Ted Cruz tweeting out last night, strong opposition. You have NVIDIA coming out with strong opposition. So the question I have is... they're going to allies or because the time? No, because they're going to restrict it going into some Southeast Asian and Middle Eastern countries. The real issue here is almost all of our export controls usually deals with the physical location, but when you're developing data centers and you can access that via the cloud, it might not matter if that AI chip can't go into China if you build that data center in Malaysia or you build that data center in the UAE. If they have that cloud access to it,
they've essentially have that technology. So the chips are going to be limited, and there's going to be new rules related to data centers to make sure that they are certified and verified that they're not giving this technology to China.
So if you have Republicans already coming out and saying, we don't want to see this happen, Biden administration is doing it on literally their final days in office, does Trump reverse it?
I think it's going to be hard for him to reverse. What they're going to do is it's an interim final rule. DC speak to it goes into effect immediately, but there's an opportunity for the Trump administration to put the final tweaks on that. If the caps are too low, look for foreign governments to be very transactional. I think Saudi Arabia will put a lot of pressure that if their cap is too low, other Gulf countries, other kind of parts of the tariff conversation, this could be a tit for tat. Hey, I'm willing to do X, Y, and Z to avoid tariffs, including trying to remove these AI caps. Is actually going to give Trump a new tool in his negotiations globally in terms of what does the U.S. have that these other countries want.
I just want to finally end on this point, because you're talking to everyone on the Hill about the process of how his agenda gets accomplished. The bond market, though, is focused on the price. What do you think we're going to see in terms of how big this bill is going to be?
Yeah, so I put the over-under as it relates to both an extension of the tax cuts and if we do an immigration, energy, defense bill at $1.9 trillion. Why do I do that? Because that was the cost of the American Rescue Plan. I don't see Republicans doing a bill bigger than Build Back Better for Biden. And so I do think that we're on the under of that.
But extending the tax cuts is way
so
more than
10 years of the tax cuts is $4.6 trillion. 4 or 5 years of the tax cuts is about $1.5 trillion. What would you do? I'd probably see it goes to 4 or 5 years. The original was 8. You say, hey, we did about half as good in trying to get those other things. People have been too focused on the 10-year extension. I think it ends with a much shorter extension.
Ed Mills, thank you so much for joining me in the studio this morning from D.C. Jonathan, a long list of issues that the incoming Trump administration is going to deal with: TikTok, export controls, and of course trying to get this agenda through, which Ed Mills says could be under $2 trillion.
AMH, appreciate your time. Thank you. With us around the table, Stephanie Roth of Wolfe Research. Stephanie, good morning.
Good morning.
That's quite a number. What do you make of it?
It sure is. I mean, first of all, it's quite a number, but average hourly earnings were 0.28. So this is kind of a Goldilocks type of report in a way. Of course, markets are trading it as a hawkish print. But the reality is that wages are growing at below 4%, even with job gains running this strong.
So we don't have to start talking about interest rate hikes anytime soon at the Federal Reserve?
I don't think we have to be talking about hikes, but we have to start thinking about when is the Fed going to be pausing. That's the real question.
Well, now, I think that's what people are saying, right? They're on pause, period. I think the question is just when are they going to revive? I want to go to the point that you're making about inflation, and that this does sort of question just how much inflationary pressure is under the hood of some of these gains. How accurate have the average hourly earnings actually been when it comes to inflationary pressures? Because ultimately, if people have jobs, they have been shown the willingness, particularly of millennials, in paying premium for premium seats on airplanes and other things. I mean, there still is the impetus to spend if you have a job.
Yeah, I mean, it all comes down to the labor market. If the labor market remains healthy, then people are going to go out and spend. The thing is that wage growth is still running, that 4%, which, given where productivity is, the Fed can kind of accept something like that. So, and the Fed has said this a couple of times, that they don't believe that the labor market is really causing significant inflationary pressures. So now the question is just that can the Fed stay on pause from here, or can they cut 1 or 2 more times?
So Wednesday's ADP numbers on earnings showed a difference between 4% wage increases for those who are on the same job, 7% for those who are changing jobs. And the question becomes, if we continue to create so many jobs, if vacancies are already at a 6-month high, at what point do earnings become the lagging indicator? At what point do earnings respond to what's happening in terms of the quantity of jobs?
Yeah, and that's the trend that we saw, in 2022 and 2023, and the labor market started to heat up. There was that differentiation between job switchers and job stayers, and that is something to keep a close eye on. But as of now, the wage data have been fairly contained, and if we didn't see a wage price spiral in 2022 and 2023, it's very unlikely we'll see it this time around. That was the real strength in the labor market, and it didn't really unfold into something that was out of control wage inflation. So this time, I don't anticipate that will be the case. To get to your question earlier, how accurate is the wage data from month to month? Not great. This probably had some calendar effects that pushed down some of the data, but on a year-over-year basis, it's in line close to what the ECI is saying, which is kind of the gold standard anyway. So I would say, maybe it was artificially depressed by some of the calendar effects, but the reality is wage growth is running at something close to 4%, which is somewhat tolerable for the Fed.
So how confident can we be that we don't get the second round effect? Because some economists will tell you it's not surprising we didn't get in 2022, 2023, because people had no memory of inflation. So they didn't think that they needed to adjust. Now, 3 years later, people have to have a fresh memory of inflation. So can we be as confident that it's just a one-off? We don't get the anticipatory wage demands. We don't get the anticipatory price increases.
I mean, and that's going to be the challenge for the Fed, which is probably why they're going to have to sort of wait this out for a little while. And with tariffs, of course, that makes it a little bit more challenging. But I think at the end of the day, we'll see that the inflation is probably going to stay sticky somewhere between 2 and 2.5%, but I don't think we're risking 3, 4, 5% like we saw last time. So I think this challenges the narrative that inflation is going to easily get back down towards 2%. But something that we saw the last time has to be driven by supply chain issues, which we currently don't really have.
If you are just joining us, welcome to the program. Just moments ago, a big upside surprise on a payrolls report coming in at 256, the estimate 165. Unemployment dropping back as well to 4.1% from 4.2. Off the back of that, some big moves in the bond market, particularly at the front end of the curve. The 2-year up by double digits. Off the back of that, as you might expect, some dollar strength. Euro dollar getting closer and closer to breaking 102. And if you check out the equity market, equity futures down across the board. On the S&P 500 down by 0.8. On the Russell, the small caps negative by 1.7%. We'll see if all of this sticks. We are on 5% watch on a 30-year yield. Lisa, the higher the session, 499.81.
And we're pushing back the potential for a first rate cut of 2025 from the Federal Reserve to, at one point, October. Now we're back to September, but really pushing it back. This is where we start to wonder, particularly in the small cap area, how much this becomes restrictive for a small subset of companies. And I think about housing, I think about mortgage rates and how much that can remain dissonant from the rest of the strength from elsewhere before, it actually calls into question some of these dynamics.
Joining us now is Jeff Rosenberg of BlackRock. He's got thoughts on this market, I'm sure. Jeff, first of all to you, sir, and welcome to the program. Your reaction to that number from 12 minutes ago?
Yeah, well, clearly it's a strong number, and that's the market reaction. That's the first point. Second thing is the retail component here. It's worth kind of like thinking about what's going on here. So it's having kind of an effect in two parts of the report. The retail numbers underlying are stronger because of the shift between November being negative because of the lateness of Thanksgiving and Black Friday. So you're seeing a little bit of a flattering on the headline number. The other thing is that average hourly earnings, which your last guest was talking about, which is kind of like it's maybe not so strong. We don't have to worry about inflation because it's, a weaker average hourly earnings print. You got to be careful. And the question was, how reliable is it? On these monthly payroll reports, the problem is the mix shift really can mess with that number. And the boost to retail this month may be factoring in. Those tend to be lower paying jobs. And so it may be actually understating the average hourly earnings, which if you didn't have that mix shift, this may actually be even a stronger picture, which is then the third point. This is just financial conditions tightening because it's less need for the Fed to cut. We priced out most of that. Most of that shift happened in the FOMC December meeting, but this is even further pushing it along the way. Now, Jonathan, you asked, does that mean, when do we start talking about the Fed having to hike rates? No. This is pricing out any need for the Fed to be cutting and pushing on my longstanding, refrain every time I come on the show is just financial conditions are really undermining the Fed's view that their policy is really that tight. And so they don't need to be worried about how tight their policy is. And so this is pricing out some of those future cuts for 2025. Not that we had that many priced in to begin with.
Jeff, you've asked and answered most of the questions that we had. So I do want to go to this question of what do you do with this, right? I mean, does this make you more bearish on equities, or does it actually make you more bullish? Because ultimately, you're not going to find the value in fixed income. It is going to come from the growth and the strength that we just saw reflected.
Yeah, and you touched on it as well. It's a good report, and Mohamed's first point was like, hey, this is good news. This is American exceptionalism. This is a strong economy. That should be good for stocks and risky assets. And I think that ultimately is the case. I think the market and the valuations have to get over the idea that you're facing some higher interest rates. I think from the fixed income lens, the higher interest rates are actually bringing relative value back to fixed income. We've really shifted the pricing of how much do we need the Fed to support. You talked in the earlier segment about the asymmetry. I very much agree with that the asymmetry is now kind of more in favor of fixed income in terms of how much more rates can go higher versus the potential for them to go lower. And we priced out a lot of that expectation of the support from the Fed, and I think that's helpful to the pricing of the bond market. And the kind of the sell-off that we're seeing here in the front end, leading, I think that has reinforced the attractiveness of yield in the front end of the yield curve.
Jeff, it seems that we're very comfortable with the notion that this pushes back whatever rate hikes, who rate cuts we're going to get, and we're going to get fewer, etc. But the minute someone mentions a rate hike, everybody gets really, really uncomfortable. Say, no, we're not there yet. What does it take to get there?
I think it takes a lot to get there. I mean, that's a very big swing. And obviously what it takes to get there, Mohamed, and you know this, is it's inflation. And not just like the somewhat unease of sticky inflation, but a complete change in the narrative that for all the forecasting of the underlying components and the imputed data and our understanding of inflation, that we've just gotten that so wrong. And there's a reacceleration in inflation. I think you have to have a reacceleration, not the slowing in the movement to 2% to shift the Fed and the market's expectation that this goes to tightening. I think it's a very high bar to get there, and we're really just pricing out the last few expected cuts in 2025.
Well, Jeff, let me put it another way then. How high is the bar to cut again, given what we've just seen over the past few months?
Yeah, I don't think the bar to cut again and to change the expectations on cutting is that high either. I mean, look at what we went through last year in terms of the swings in market expectations on what the Fed would do and the Fed's own forecasting on what it would do and the extreme data dependence here. So the bar to more cutting is we're seeing that stabilization in inflation. There's not the risk on inflation. And for whatever reason, obviously not the story today, you're seeing that slowdown that the Fed has feared in the labor markets. And a couple of data points on labor markets, again, not what we're seeing today, sub 100, pictures, increases in unemployment rates. You get two reports in a row of that. You could very quickly shift the narrative back to, the Fed's got to cut 2, maybe 3, because of this extreme data dependence that we have the Fed driving market expectations.
I see Stephanie Roth nodding along. I do want to just point out that briefly, the 30-year yield did hop above 5% before coming back down, but it's right now 4.9. Up, there it is, 5%. Once again, you're shaking your head. Do you agree with what he's saying?
Yeah, I agree. The Fed's been data dependent, but very much on every data point, right? So to the extent that we have another couple of prints that are a little bit softer in the beginning part of, in the next couple of months, then the narrative could shift to some extent. We've seen every 3 months the market has been swinging from soft landing to hard landing to no landing, and realistically, you're probably somewhere in between. So base case at this point is the narrative is going to continue for a while. Then you're going to have the Q1 inflation seasonality problems again. So it's probably going to be towards the middle part of the year when we could start talking about potential cuts again.
So Stephanie said the Fed is data dependent not only overall, but to every single data point, which of course Powell would push back on you and say no. And that makes us all data dependent, right? And it makes us all add volatility to a market because we get swung around. Doesn't that bother you? Doesn't it bother you that everybody has become so data dependent?
It does. Nobody should be caring about the unemployment rate to 3 decimals and average hourly earnings to the same kind of thing. I just had that conversation with Tom Keene earlier. It makes us uncomfortable, but we all have to. We all are in this environment, even though they're trying to steer us away from that in theory. The Fed continues to get swung around by every data point, so then we all have to focus on the same thing and figure out every nuance within every single print. The retail thing is a good point in the sense Fed said it was minus 29 last time, and now it's jumped back up 43. Realistically, that drove some of the strength, and you probably should smooth that out, but we're in an environment that it's going to be tough. And by the way, next print, we're going to be impacted by all of the fires, and that's going to be a really messy data point as well.
Can you think of any Fed that got swung around as much as this Fed is getting swung around? I mean, I think back of the financial, I think back of so many bigger episodes.
Mohamed, I go post-pandemic. Post-pandemic, this Federal Reserve allowed the administration at the time to come out with huge fiscal plans in a supply-constrained economy and just say, we'll look through it. We'll look through it. They weren't data dependent then. They waited. The change in behavior on the FOMC, I hear a lot of economists, present company excluded, a lot of economists who are more keen to defend the institution than provide critical analysis of it. That's really problematic for me, for economists on Wall Street who are hell-bent on making sure that their friends at the FOMC still give them access to have conversations at NABE, etc., than actually just calling things out for the way they see it. This Federal Reserve has behaved very differently under Biden and has changed when Donald Trump has come into power. They've opened the door to those accusations themselves with that news conference back in December. Without a doubt, do you agree?
No, I agree that now we have a Fed that's navigating two things, the monetary policy landscape and the political landscape. It's not navigating one thing anymore. It's navigating two things, and we just have to keep that in mind.
Why wasn't it navigating the political landscape 2-3 years ago, when it was clear that fiscal policy was in the driving seat?
I think 2 or 3 years ago, they were asleep. And the rush to call inflation transitory, ignoring the policy side, ignoring all the uncertainty, was a big mistake. And because of that, they became extremely data dependent. And they don't even want to look forward anymore. And it's ironic because we're dealing with markets that are supposed to be looking forward. We're supposed to be discounting the future, right? And yet we've all become completely dependent on what's just happened. It's absurd, but that is what happens when the institution with the printing press in the basement decides that it will become excessively data dependent. It turns us all into extreme data dependency.
They meet again at the end of this month. We'll get 2 more data points before then. CPI is one, the inauguration is another. What's this news conference, this meeting rather, going to look like at the end of this month?
Yeah, I mean, I think we're gonna. Well, let's first talk about maybe CPI because that we're looking for something that should be a little bit more soft, something like 0.24% on core, which should be okay. I don't think it's going to change anybody's view, especially after this print. This print made the CPI a lot less important. And then we're going to have to see from the Trump administration what's going to happen in terms of immigration. That's going to be one of the biggest things that's going to happen probably right off the bat. How aggressive are they going to go? It's probably going to be at a lot of I'll bark at the beginning, and then realistically we're not going to see that much deportations because that's going to require funding that they don't have, and it's probably just going to be people rolling off the humanitarian parole and TPC. But that's going to be a big thing to watch out for. And then the second is what's going to happen from a tariff perspective. We haven't really heard much specifics. We're rewinding back to the announcement on Canada and Mexico. Are we going to get more of that? Probably not. We're not hearing much of it. But those are the two things we're looking out for most from him: tariffs and what we're hearing from an immigration perspective.
Jeff, as an investor who has to take a longer-term view, how do you remain independent from this excessive data dependence that we were just talking about? How do you have any conviction with calls at a time where people are talking about how much the parameters could change based on whether it's CPI or whether it's January 20th and the inauguration?
Yeah, it's really recognizing, the things that you think you can forecast and recognizing the things that are just not forecastable. And we have a little saying, if you can't forecast, and I would put all of the policy uncertainties that were just described in that category, then you have to observe. And so you just kind of know what you can kind of control and know what you can't control, know what you can forecast, know what you can't forecast. Try not to overreact to every data point. But on the fiscal policy, I mean, that is basically the story for the 2025 outlooks is uncertainty and unforecastability. So we're going to have to kind of recognize that, and we're going to sit back, we're going to be patient, we're going to observe, and then, as the information becomes more clear, that's when you can take action in your portfolios. To try to do it ahead of time, I think you just have to recognize that's a very difficult exercise, both forecasting what is going to be the policy and equally forecasting what is going to be the market reaction to that. Getting both of those right is very unlikely, so you're going to have to sit back and wait for the data to reveal itself.
Hey, Jeff, appreciate your time, sir. As always, Jeff Rosenberg there of BlackRock. We'll take a step back and a big deep breath and look ahead to CPI next Wednesday as well, and some bank earnings too. Mohamed, just a final thought around the table. We came into 25 thinking about US exceptionalism and global divergence. And Lisa and I have been talking about this for a number of days now, a number of weeks. The extent to which we can keep stretching that rubber band, how far can we take that? How much oxygen is left in that story before we get these negative feedback loops and things start to move in the other direction?
I mean, that's a great question, and I'm not sure I can answer that, but I can tell you that the theme of dispersion is really important because there's a limit to how long you can run a system with significant dispersion. And we have two main dispersion issues, US vis-a-vis the rest of the world. The hope is the rest of the world comes up to the US. The fear is the rest of the world drags the US down. And then within our economy, low income versus the rest. Low income they're struggling right now. We must not forget that. And these numbers cannot make us not also consider what's happening at that end, because at some point that we can migrate up. So the theme we're going to be talking about a lot is forget about averages, look at sectors. And that in the marketplace, we've gone from a market focus to a theme focus, and now it's going to all be about individual names.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.